Hello, everyone. Welcome to the first quarterly Asia Trade Floor update in 2026. I'm Jingjing Huang, credit strategist. Today with me, we have our Asia Credit Portfolio Manager, Stephen Chen. Thank you for joining us, Stephen.
Hi, Jingjing. Great to be here.
So, Stephen, in our new cyclical outlook, compounding opportunity, we talk about resilient growth, but also widening divergence. What are the key takeaways for investors?
Global growth has held up better than expected, helped by AI-related investments and productivity gains. But that resilience is uneven. We are seeing more of a K-shaped dynamic. Companies and sectors benefiting from AI-driven investment are pulling ahead while others lag. At the same time, policy paths are diverging. Some central banks still have room to cut, while others are already close to neutral. For investor, this creates durable opportunities in high-quality fixed income. Starting yields are still attractive, and global divergence give active manager room to add value.
And those global dynamics really matter for Asia, especially in China. How are things shaping up there?
China is trying to keep growth in the 4 to 5% range, but it needs ongoing policy support. Stronger domestic demand growth is an objective, but it's trending softer. Retail sales are losing momentum as earlier stimulus effects fade, and real estate is still a big drag on confidence and investment. That's why fiscal and monetary policy are staying accommodative, with more support for consumption, social welfare, and strategic infrastructure. From an investment perspective, Chinese government bonds still look attractive given subdued inflation and continued easing. The currency picture is also improving, with the People's Bank of China focused on keeping things stable.
And China's export engine is still going strong.
Yes, China's manufacturing scale and cost advantages remain intact. The new 5-year plan, which begins this year, puts major emphasis on productivity and technology. That's helping China expand its export share and move up the value chain. But even with that strength, the spillover to rest of Asia aren't what they used to be.
So what has changed?
A few things. Chinese export prices are soft, which keeps inflation low across Asia, but it also pressures regional trade balances and corporate margins in many economies. Export momentum in the rest of Asia will likely weaken from last year's high base, especially for economies not tied to the semiconductor cycle. Meanwhile, the more open, tech-linked economies such as Korea, Taiwan, Singapore continue to benefit from the AI-driven electronics upswing. Outcomes across the regions are becoming increasingly uneven.
Let's turn to Japan and Australia. How are you sizing up the opportunities there?
Japan continues its gradual policy normalization, but what's changed meaningfully is valuations. Long-end yields are now pricing in high forward rates, with fiscal concerns and reduction of bias after decades of low rates. That's why we prefer the 30-year area of the curve, where yields already reflect a lot of those risks. Australia tells a different story. Growth is steady, but households are still facing restrictive conditions, and inflation recently moved back above the RBA's target band. While further tightening can't be ruled out, we think the RBA is more likely to hold rates near current levels. That makes longer-dated Australian bonds attractive, particularly given the yield premium over U.S. Treasuries.
Thank you, Stephen. That's all the time we have for today. For more details, please read our latest APAC market outlook. Stephen, thanks again for your insights, and thank you all for watching.
Thanks, Jingjing, and thanks everyone for joining us.